When interest rates rise, buyers tend to take a break from searching for homes and ride the bench, waiting for rates to come down. My favorite phrase lately is marry the house, date the rate. If you are waiting for rates to come down, guess what? So is everyone else. When you are ready to get back out there, you are going to find yourself in a crowd of pent-up demand, and we are going to once again be in the land of low inventory, high demand, bidding wars, additional down payments, waiving inspections. You get my drift. Today, I'm talking about a creative solution in this dynamic market, one of which is seller financing. Thank you for watching. I do a new video on life and real estate here in Southwest Washington every week. If you like what you see, take a moment to subscribe and turn the bell on for notifications. If you are curious about what home prices are like here in Southwest Washington and you want to set up a home search, use the link in the description below to get yourself started. Or if you want to talk about what it's like to live in this part of the world, feel free to reach out. My contact information is in the header above and also in the description below, and I'm pretty easy to get a hold of. You can shoot me a text or email to set up a time to talk, or just give me a call. So let's get back to the topic of today. We know that as a buyer, it's not ideal to be shopping for a home when rates are like 5 or 6 or even 7%, especially if you were starting to think about buying, in the past few years when rates were in the 3s and 4s. As rates climb, something we just tend to see more of is seller financing. So as buyers get priced out of the market, sellers may choose to cast a wider net in the buyer pool by offering to finance the house so that a buyer does not have to go through a bank. So that this might be more attractive to buyers who maybe they need credit repair or they don't have very much money for their down payment. Or it could be handy for buyers who are short on closing costs and they want to maybe use that money that's set aside for closing costs and let's add that into our down payment. Because as the seller is the bank, they get to decide what they do. There's not gonna be like a loan origination fee or anything. So what is seller financing? Seller financing is when the seller is the bank. They set the rate and the terms of the loan, and then they are carrying the contract until the loan term. And that's something that's agreed upon between buyer and seller. It's not like a blank template, 15, 30 year. No, you work that out with the seller directly. So as there are fewer buyers in the market, this is something that sellers might be more open-minded to. Offering financing can give sellers listings a competitive advantage over other listings. Also, it might make sense for a seller if they do not need the cash proceeds from their sale to buy another house, and they're willing to wait to get the full proceeds from the sale. Just to be clear, seller financing is not lease to own. It's also not an option to buy. It's simply a twofold contract between a seller and buyer. The first part being the contract setting the terms for the home sale, including the price, the down payment, the closing date, and any contingencies involved. And the second part being the financing terms, such as the interest rate, period of time until the loan needs to be paid off, any balloon payments, etc. A perk to buyers is that the loan terms will be more flexible than working with a bank or credit union. There may be no minimum down payment, you won't have to pay mortgage insurance, and the seller may be willing to work with you even if you don't have stellar credit. So how does it work? Well, the safest way to do this is to find a listing where the owner owns the house outright so that they have no loan and is willing to carry the contract. Not all sellers are willing to do this, especially if the home is their primary residence. They probably need the cash proceeds from that sale as a down payment on the next house that they're going to buy. So finding a house that you like with a seller open to carrying a contract might sound like a needle in a haystack situation, but it's not impossible. Before we talk about how we find this needle in a haystack, I want to go over one important component. We are going to be looking for homes that are owned outright. The seller has to have no mortgage. If the seller has a mortgage on the house, then the whole situation gets a whole lot riskier because the seller will remain on title. And what if they do something like they stop making their mortgage payment, or they have a judgment filed against them, or maybe they stop paying child support? All of these things can end up generating liens against the property that you now own and live in and are not entitled to. So if they get foreclosed on, the house gets foreclosed on, what happens to you? So you can see that's going to create a world of problems. So we are going to stick to talking about seller financing on homes that are owned outright, no mortgages that the seller has. If you found a house you were interested in, the seller owns the house outright and the seller is willing to carry the financing, then we can write a contract. A promissory note would be created detailing the terms of the loan and amount owed from the buyer to the seller. The note is the agreement to repay the money. At closing, a deed of trust would give the buyer ownership subject to the loan per the note. The deed of trust pledges the property as the collateral for the loan repayment. The seller is treated like a financial institution and the buyer goes on title. If the seller still has a mortgage on the property, that seller is going to remain on title. So this is an important distinction there. So when does the home get paid off? Seller financing usually involves a balloon payment after a certain period of time. For instance, after 5 years, the buyer is going to pay off the remainder of the loan from the seller. How will you get the money in 5 years? Maybe you're going to get a mortgage. Maybe you are using seller financing as a bridge while you wait for rates to come back down. Or maybe you're not planning on staying in this house for more than 5 years. So you can buy the house on a contract, let it appreciate, then sell it in year 4, pay back the seller, and walk away with a little extra money in your pocket. How does seller financing compare to using a mortgage when rates are high? Well, it's common right now to buy down your interest rate. For example, I was interested in a rental property recently where the seller was willing to pay $15,000 to buy down my interest rate. As an investment property getting a loan, the rate would still be higher than I wanted, and I will have already spent $15,000 to get that rate that I didn't even like. So I like the price of the property, but it just did not make sense to waste that money buying down a rate that I was just going to refinance out of as soon as rates come back down. If the owner didn't have a mortgage, it would make more sense to come to a deal with them directly without involving a bank, to come to an agreement on the price, the rate, the down payment, and repayment schedule. I'd rather do that and then get a loan when rates improve to pay off the seller finance loan. Or make money having it as a rental for 5 years, let somebody else pay that payment to the seller, and then sell it to pay off the loan and also gain the appreciation before my loan term expires. So let's say you've listened to all of this and you're like, yes, that sounds like it might work for me. I'm interested in learning more about this and finding a house that the seller would be willing to be the bank on. So there's a few ways to get started. First, you can look at all the listings out there, and then we can find out together by talking to the listing agent and the property owner if the seller is interested in financing the sale and what the terms would be. Another option would be to set up a home search with me through the RMLS to find properties that are being offered with owner financing. Again, this is not a common method of financing, but I've seen it done and it does work. There are definitely risks involved, so before proceeding down this path, consult with a real estate attorney. If you want to talk about this more or ask me any questions, give me a call or send me an email and we can set up a time to talk.